looking forward for the next speaker, Jon Staenberg from Agata Hound, because I told you that recently I started as a CEO and co-founder of a startup. So I'm now looking into this world of venture capital, right? I'm having all these talks with VCs, with investors, and now Jon is here to tell us why he left venture capital and have not looked back. And we're going to find out about a primer on search funds, and I'm super interested to hear about this. So welcome, Jon, and thank you so much.
Thank you. Welcome, everybody. I'm super excited to be here today. Let me give you a story. So in 1988, I graduated from the Stanford Business School. And I was lucky enough to be in Silicon Valley back then. And I saw technology at its infancy. I saw innovation, and I learned about venture capital. And I was sure that that was the future. And it's all I could think about. In fact, I was ready to go straight into venture capital from Stanford. But someone said to me, don't do that. Go get a job for 5 years. Learn about hiring, firing, making decisions, and having to live with them. So I went to Microsoft. Microsoft was about 2,000 people at the time, and it completely changed my life. It was run like a startup back then. But I never forgot my goal. My goal was always to do venture capital. It was blindingly obvious to me that venture capital was one of the greatest asset classes in the world, and I needed to be in it. But venture capital back then is completely different than it is today. Venture capital back then, everybody knew each other. There's a famous road in Palo Alto called Sand Hill Road. You could walk up and down that road, and everybody knew everybody. I literally would go knocking on the doors. I'd have lunch, breakfast, and dinner with these folks, and we would share deals. Let me fast forward to today. Today, venture capital looks nothing like that. And part of it's good. It's now worldwide. There's lots of different models. There's lots of managers. But it became something I didn't know how to do anymore. When I started doing venture capital, it was basically a serial rollout of technologies. And today, it is a flood of competing technologies all at once. And so even though I've done, probably 500 deals in venture capital, about 7 years ago, I looked at myself in the mirror and I said, I can't do it anymore. I don't know how to do it. I'm not good at it anymore. And it wasn't as much fun for me. And the problem was, for me, that venture capital, for all its strengths and for all the excitement around it, it has a lot of problems. And I kind of characterize the problems of venture capital around alignment. There generally is not a very strong alignment between the investors, the startup companies, the CEOs, the markets. And so that has led to a lot of problems. I'll give you just an example. Not only did I run 3 venture funds, but I was a prolific angel investor. Angel investors, as you all know, come in early, take all the risk, and should be rewarded for that risk. But it doesn't work out that way many of the times, right? What happens is you come in, the company's barely started, you put the first money in, the company starts to do well, along comes the venture capital guys and women, and they say, we don't really care about you, angel investor. We're now going to control the rest of this. And you get kicked out, or you get the preferences change, or the terms change. And where are you? You took all the risk. And after a while, I said, that's not right. And so again, 7 years ago, I started looking at the world, and I went back to Stanford, and I met with my professor. His name is Irv Grossbeck. And by the way, I'm from Omaha, Nebraska, and that's in the middle of the US, and maybe some of you have heard about Omaha because it's where Warren Buffett also lives. And Warren Buffett's a hero of mine. And Warren Buffett is what's called a value investor. And I have never forgotten, I go to the annual meeting of Berkshire Hathaway every year. I read the annual reports of Warren Buffett. And his teachings, and if you haven't read them, please do. There's so much wisdom in those annual reports and the quotes and the sayings of Charlie Munger and Warren Buffett. You should read that. But it has informed me throughout my life and my investing life. Anyway, I went back to Stanford 7 years ago, and I met with Irv. And Irv is very similar to Warren Buffett. He's 87 years old. He's still teaching. He's got wisdom. And he is the guy that 40 years ago when I was in business school, yes, I'm that old, he's the guy that invented something called search funds. Now, Irv has done almost everything right in his whole life, but naming them search funds was the only thing I can think of that is a problem. And so today I'm going to explain to you what a search fund is, and I guarantee even after I explain it, some of you are still going to say, what is a search fund? But I'm going to do my best today, okay? And a search fund is neither about Google searching, and it's not really a fund like we think of venture funds. So let me talk a little bit about what they are. Here's our quick table of contents. I'm going to speed through many of these slides, and many of these slides I'm not even going to address. The main thing I want to explain to you today, the takeaway here is you should walk away saying, search funds are about the coolest thing I've ever not heard about. I know what they are, and maybe I should do more work in learning about them, and Romania might be the best place in the world to do them. We'll find out. My background, which I told you a little bit about, I have a partner in this, but let's get to what search funds are. They've been around for 40 years, and yet most people have never heard of them. Over 40 years, they have averaged, and this is where you get to do a little research on your own, go to the Stanford Primer on Search Funds and the Stanford Study, you can Google those, and you'll see they've averaged net returns of 35% a year. That is a big wow. If you look at venture capital over that same period, it's about 12.5%, 13%, depending on how you slice and dice the data. So it has crushed venture capital. Now, to be fair, venture capital has exploded. It's much bigger. This is a very small asset class. Stanford and Harvard invented search. And they were the only two business schools, graduate business schools, that taught search for 20 years. What's exciting is today, 6 continents around the world have searchers. Over 50 business schools around the world teach search. I keep saying search. It's now called ETA, which is entrepreneurship through acquisition, which is a great description of what you're doing, okay? And what it is, now we get to what it is, it's where an MBA comes out of Stanford, Harvard, Wharton, INSEAD, London Business School, ISA, IA. They come out, and instead of taking a job in industry, instead of starting a startup in the tech world, they come out and they do a fundraise for a small pool of money to fund themselves for up to 2 years while they search to find a boring small business to buy and then run. That's a lot of words, I apologize. But part of the magic of this is that the professors that teach this class have the funds that invest in the students that then propel them into finding the acquisition, and the professors stay along the whole time and mentor, coach, train, and teach them throughout the process. So what happens is you take this 32-year-old from Harvard Business School. They probably haven't ever run a company, but maybe they did consulting, maybe they did private equity, maybe they were in banking, but they're hungry and they want to run something and they're entrepreneurial. And so they say, I'm willing to spend 2 years of my life getting paid less than I would if I went into industry so that I could go find a company to run. And then I get 10 investors around the table or 12 investors around the table that have all done it previously and mentor me while I grow this company. It's small. It's very, very small, but it's growing very fast. I often say search today, ETA today, has the exact same feel to me as venture did 40 years ago. It's like a light bulb has gone off for me. It is so obvious that this is such a great asset class, and the rewards are so fulfilling, both monetarily, but also for the entrepreneur who wants to go out and run something, that I literally have given up all my other activities in business just to focus on this. But it's small. There's only been 800 funds since 1984. The total invested is less than $4 billion. There's many venture funds that have raised that for one fund. So it remains small. This woman is out there telling everybody on social media, on TikTok, on Instagram, on YouTube, that everybody should go buy a business. And she's right, because the demographics are very compelling. Everybody knows the baby boomers. They're getting older. And everyone knows the baby boomers make up the majority of small businesses. And the majority of small businesses make up most of the business in most of the countries. In Romania, small business is 99% of all businesses. That's true throughout the world. What's also true is the kids of the baby boomers are no longer interested in taking over the family business. So you have what is called the silver tsunami. That's where old people with their graying hair are wondering, what am I going to do with my business? Many of them are just going to close the door. Right? They don't even know what to do. So the opportunity here is to go out and to get in front of the silver tsunami and buy one of these businesses. Now, what she says is it's easy to do. I'm going to tell you it's not easy to do. But the search fund playbook, and I want to emphasize it's a playbook, and that's where probably a follow-up comes in, because it's a nuanced, fairly detailed playbook. But that playbook is how you win. That is how, and there are books on it. And then afterwards, if you want to ask me about that, I'm happy to give you resources. But it's a playbook because small businesses, we buy them pretty cheap. We buy them on average of 4 times EBITDA. And then we sell them after we've grown them to private equity for 10 to 12 times EBITDA. So we're creating value right there. But the reason we're able to do that is because small business is messy. It's hard. But with the right training and the right coaching around you, it's an unbelievable journey. I created a fund. In fact, we're the first fund of funds investing in search because I wanted for my own portfolio to have access to this. And no one had done it. So we created basically an index fund for small American business in the United States and North America. Europe is now starting to see incredible proliferation of search fund investors. It's a really exciting time for Europe. And the main areas today, Spain by far has the most, but England, Italy, and it's moving east. So how does a searcher do this? So they raise this search fund, and it can take 2, 3, 4, 5, 6 months. I'm going out. You want to invest in my search. Remember, it's a 2-part process. Then I spend up to 2 years. And by the way, a lot of searchers never acquire. It's a brutal job. You're getting on the phone, you're calling people, you're doing emails. And it's very hard to find a deal that fits the criteria and gets to the finish line. So now, let's say I get to the finish line and I get to acquire a company. Now I have to transition it. I have to take the lessons from the previous owner. They become a mentor. They help with the transition. They put a seller's note on. They put some debt in. We don't put a lot of debt, but a little debt. And we grow it to the point where we get an exit. And on average, we're getting 3 times our money back at the exit. And it's very different from venture capital. How does venture capital work? Venture capital says, I'm going to have 10 investments, and one of them is going to make my fund. That's how I plan it, right? This is the opposite. Almost every one of the companies we acquire is going to have some kind of positive outcome because we're buying profitable companies. But none of them are going to be a Google. None of them are going to be a 100x. But we'll have 3x, 5x, 6x consistently. I told you who the searchers are. The investors, and there are not very many. It's a very small world. Remember I talked about Sand Hill Road? The investors today are the same people who have been doing it for 30 years. And they haven't really wanted to tell anyone else about this. It's been so good that they haven't wanted more money coming in. Well, that's changing, and more money is coming in. And so it's becoming a really interesting moment, but it's fine. And the reason it's fine is because of that silver tsunami. And the reason it's fine is because the wave of all these businesses that are coming to market. And I think, and here's where I'll relate it to what's happening here today. What I think is maybe the most exciting piece, and I don't talk about this a lot. I mean, when you already have 35% returns, why do you have to do better? But what if AI is the game changer for small businesses? And by the way, if I'm a 32-year-old coming out of Stanford, I'm super comfortable with AI already, right? I'm going to apply it to my small business versus the 65-year-old down the street who's not going to. So all of a sudden, I have a huge advantage. So what kinds of companies are we buying? These are the industries. We're buying fragmented industries. We're buying growth where there's growth. We're buying companies that have at least 3 years of growing EBITDA. We're buying companies that have $2 to $5 million of EBITDA. We're buying on low multiples, as I talked about, and they generate cash. But what are the actual types of companies? Pool cleaners, meter readers, plumbers, electricians, dental clinics, med spas. Pretty exciting, huh? You want to go to a cocktail party and talk about that? But we call them good boring. And that's what we like. Because if you think about it, when you're in venture capital and you're starting an AI company, you're basically trying to go from 0 to 100. What we're trying to do is go from a 30% good to 45% good. But it's completely entrepreneurial. So if you're thinking about an entrepreneurial path, you might want to think about this. I don't know if Romania has a search fund. I actually got on ChatGPT this morning, and ChatGPT couldn't tell me. But I'm sure there's been 1 or 2 here. But think about that, 1 or 2 in a country that has hundreds of thousands of small businesses. Therein lies the opportunity. This gives you some more numbers. There's too many words on this slide, but it's saying what I was saying. There's a lot of B2B services. There's a lot of healthcare. There's not very much technology. We don't buy a lot of tech companies. We'll leave that to the venture people. We'll buy some IT services. But my fund will have 200 companies in it across 150 different types of industries. And for me, it's really fun to learn about these different industries I never would have thought about. I got into venture capital because I love the learning process. I love learning about new technologies. But I'm also equally excited about learning about small businesses that are niche. I have a woman who is buying a company that brings equestrian horses into the United States. She's one of 7 companies in the United States. I wouldn't have known anything about that, but I didn't even know that business existed. And that's what a searcher does. They go out and find those kinds of businesses. I talked about the incentive alignment. I'm going to give you one quick story on this. So if you're a searcher, you get equity. So you've got the investors putting the money in, but you get equity. You get 25% equity. But you only get the equity in 3 tranches. You get it when you acquire a company, that's a third. You get it after 4 years that you've been working there, that's another third. And then the interesting piece of alignment here is that you get the last third if the investors get a 25% IRR. That's kind of interesting. I wish venture had that. I'll tell you what venture has. Venture says, oh, you raised all this money, and then you ran the company into the ground, but we're going to pay you a couple $1 million to close the company down. What? That's not alignment. Let's skip that one. This is something called the anatomy of ETA returns. We basically create value in several ways. We do it through our multiple expansion that I talked about. We do it because we're growing the company organically. We're doing it through margin expansion. And we're doing it because we can put a little debt on it, and our debt is much cheaper than our growth rate. And so at the end of the day, and this is pretty conservative, you can see where we started at a $30 million company and ended up at $63 million on this company. This is in the Stanford study, so I would encourage you to look at that. But again, 800 searches, $3.5 billion put in. It's small, it's at the beginning, there's opportunity. Most of you will walk away from this going, that's interesting, but I want to go do a startup in AI and venture, and that's okay. This is not for everyone. The people that do this, there are generally 3 types of people I run into that do a search fund. Immigrants who will work their tail off. They'll live at the place of work. People who come from the military. They like a good playbook. They understand discipline and following the rules. Or kids of entrepreneurial families that talked about small business around the dinner table growing up. Right? But those are the types of people. The people that are looking for the cushy jobs with the free lunches and the 40-hour work weeks are not going to do this. It's not for everybody. And my job as an investor is to figure out what your true motivation is. Are you willing to climb that mountain? Are you willing to sleep at the place of work? Those are the kinds of people I'm looking for. This is about my fund, not that interesting for this conversation. Then more about the fund. And so let me just summarize. This is a model. It's a small model today. It's growing. It's a model that has the elements of alignment, playbook, mentoring, coaching, and teaching. It's proven. Do you know in 40 years it's never had one down year? You guys know the volatility. Venture, you can't invest in one venture fund hoping that that's the one. Who knows if that vintage year is the right vintage year? Search funds have never had that issue. Not only is it outperformed on the upside, but never having a down year, that's kind of crazy. It's insane. So, I say we're buying good, boring businesses. And I think 18 to 20% compounded returns is sexy. And that's why I'm doing it. So with that, I have about 3 minutes left. I know I went through a lot of materials. I can take 1 or 2 questions if anybody has them.
What plans do you have in Romania? What is that?
Yeah, so great question. The question is, what are the plans for Europe and Romania? So I would love to do what I'm doing in the States in Europe. Europe's about a decade behind. And what do I mean by that? The business schools are starting to teach it more, and we're building out the infrastructure around it. Just like in venture capital, right? Silicon Valley had a lead, and then the world started adopting the best practices. And that's going to happen here as well. And so I'm excited. I'm coming to Europe now several times a year, and I'm meeting with every search fund investor. And I anticipate in 3, 4, 5 years, we'll be investing heavily in Europe too. Because if you think about it, the same baby boomer demographics are happening here, and it's even more wide open than the US because there's less searchers. So the opportunity should be great, but we need to see some results first. And like the virtuous cycle of venture capital, that will happen in Europe too. And what do I mean by that? It's where a searcher goes out, he or she acquires, has a good return, and then they go and start investing in other searchers and mentoring them. And so we need some of that flywheel to start happening here. Great. All right, well, I think that's it. Thank you very much. Appreciate it, everybody.